Good afternoon, John from Saxo Bank. You're a FX specialist. We see a very strong dollar last weeks. What's your prediction for the euro dollar?
Yes, well, it's really interesting to see this very strong dollar, clearly driven by the entire cycle of interest rates rising, the constant need to adjust the Fed peak expectations for where the Fed rate is going to end ever higher, as this Fed is clearly about fighting inflation, has been having to reinforce that message constantly with each appearance, with each meeting, it seems. And then finally, it seems the market is getting the message. As well, there's the concern about quantitative tightening, what that could do to longer-term interest rates. So we think the dollar will likely peak and euro dollar potentially reach a bottom sometime in the coming months, 2 to 3 months in our estimation, based on that peak cycle in U.S. rates, and based on sort of the maximum pessimism having been reached. Even if we do face a very ugly winter ahead for Europe, that the sentiment and the outcomes for Europe will sort of be priced in in that sort of 2 to 3 month time frame for Europe. So somewhere, obviously, we're below parity. We think it could weaken further towards 90 cents, maybe at times slightly below 90 cents. But that's an approximate forecast for where euro versus the dollar may bottom for the cycle, at least for this coming winter.
Okay, and in case the inflation will not go up again, maybe the Fed could raise the rates again. Would you expect a stronger dollar again?
Yeah, I mean, if we're not finished quite soon with U.S. Rate cycle, with yields continuing higher and higher and higher, I think that does continue to aggravate the risks of a rising dollar. But I think before that happens, we almost risk, with these yields spiking to where they spiked to, if they go much further, we see something giving way or something sort of breaking, if you will, in the financial system, and it just becomes too painful. So we think some sort of intervention to at least slow that rise or slow it down, basically, relative to what we've seen at times in recent months. So that's sort of, it becomes self-limiting at some point in our view, because there's only so much pain the financial markets can take before this becomes too significant an issue and starts to cause systemic risks.
Okay, and Europe also, the inflation is also sky high, of course. Maybe the ECB will also raise the rates again. Would it strengthen the euro again, you think?
Well, it's been an important part of preventing the euro from being even weaker than it would be otherwise. The ECB finally, very, very late, coming on board and realizing the seriousness of the situation, and realizing that if it doesn't get on board with the types of rate rises we're seeing elsewhere, for example, moving 75 basis points at its most recent meeting, that euro weakness becomes an additional risk for inflation. So they're taking the situation more seriously has helped to prevent what would have been an even weaker euro. We've seen what happens to the Japanese yen, for example, where the Bank of Japan insists on unchanged monetary policy. So the ECB is on board. They're serious. They are moving, and they're moving more quickly than they have been. But I think with the Fed peaking out, the ECB won't need to hike as much as the Fed, and can't hike as much as the Fed does for this cycle, because if 4% interest rates are a problem for the U.S., they're basically catastrophic almost for the eurozone. So yes, the ECB is on board, and we think they'll take the message as serious as they need to, relative terms to the Fed right here in this part of the cycle.
Okay, lately we saw a big dip in sterling. What do you think are the causes for it?
Well, sterling is really an interesting, almost like a laboratory, an experiment for a policy response to what is a very, very ugly backdrop, a very supply-side limited economy that's driving worse inflation there. The same energy spike effects on the economy as we're seeing in Europe, and at the same time, very, very large external deficits. So where does the UK go for funding its deficits in terms of trade, etc., to fund energy costs, etc.? On top of that, you have the government subsidizing energy prices for the lower income people to allow people to stay in their homes and stay heated for the winter. That goes to the public balance sheet. And on top of that, tax cuts, which will further erode the sovereign balance sheet and make deficits even worse on the fiscal side for the UK. It's a cocktail that just doesn't add up for the currency, and UK rates at the longer end of the curve are running away to the upside, because there's just not credibility on the fiscal side. Who wants to own this UK debt if inflation levels are going to where they're going domestically in the UK? So further risks for the pound, for sterling, until the Bank of England applies the bitter medicine of pretty vicious rate hikes in all likelihood.
Okay, now back to the euro. Europe. We see in Italy some big political movements. What's your view on the euro?
Yeah, so it was kind of a really quiet election. There was a lot of noise ahead of this election in Italy with the election of what appears to be a coming Prime Minister Giorgia Meloni of this Brothers of Italy party. That party is even outperforming the polls slightly, 25% of the popular vote, quite impressive. Suddenly, Italy's largest party. Now, some of her coalition partners on this right-leaning bloc slightly underperformed, so the popular mandate at 43% of the popular vote is not massive. However, this is a character, Meloni, who has promised to roll back some of the reforms that her predecessor, Mario Draghi, brought that were sort of seemed or deemed necessary to bring these pandemic relief funds, 200 billion to be specific, 200 billion euros, to Italy. If she's successful in rolling back those reforms, again, we get into this awkward situation of tension, supposed risks of existential crisis on terms of these funds being dispersed from the EU, because Italy is very reliant on the generosity of the ECB to keep its bond yields orderly, and on the EU budget to bring some more fiscal Italy's way to deal with its support to its economy in these very ugly times of high prices for energy, etc. So it will create tensions, but it seems to be the market is treating this as a slow burn issue, and I generally agree with that assessment. We need to see how this government finds its feet and see what the behavior is like as the first sort of problems start to rise, and how these two sides negotiate.
What's your view on emerging markets?
Yeah, emerging markets are a very mixed bag currency-wise. So, but broadly speaking, you can look at the emerging market currencies and say that they've performed remarkably well, given where U.S. yields have gone and given a very strong dollar. Traditionally, as the dollar is the world's funding currency, the global reserve currency of the world, when you have a strong dollar, that tends to provide tremendous pressure on emerging markets. We have seen that pressure in places since the pandemic, but emerging markets, they know the drill. They know that when inflation goes up, you have to hike rates to prevent currency weakness, aggravating the situation. They've done so. They did so more aggressively there than in developed markets. So ironically, many of the more sort of stable emerging market currencies, take a currency like the Mexican peso, for example, been quite stable because they have relatively high, or at least neutral, real yields. In other words, the policy rate is appropriate or approximately matches inflation. Very unlike the US, where inflation is still far, far above the policy rate, or Europe, much less Europe or the UK. Other emerging market currencies taking the situation less seriously. Turkey is the real outlier here, where they're actually cutting rates despite inflation levels beyond anything we can imagine of 70% and even higher in the country, because the president is politically interfering and has these odd beliefs about what the drivers of inflation are. So it's a very mixed bag. Those emerging market currencies with a strong commodity portfolio, because that's been a big focus, have done relatively well. Brazilian real, for example, after a period of weakness, had a nice comeback. The South African rand is a little bit different because of its financial instability, so it's been on the sort of more traditional weaker side, but it's a very mixed bag across emerging markets. But very key is to have some sort of credibility on the interest rate and policy front, and not to have too large of a current account deficit, too reliant on foreign energy sources, etc. That is a key risk in this world of very high energy prices.
Okay, finally, last question. Many clients from Saxo Bank are in Europe, for example, people from Holland. If they fear the equity markets go down, for example, they can take out a lot of money from the equity markets. Would you recommend it to put it in euros, or would you recommend investing it in a mix of foreign currencies, just to temporarily stall the money?
Yeah, that's a great question, and I think the dollar is strong. I think it can go a bit stronger, but I think we're sort of getting there in terms of peak dollar strength. So one needs to have maybe hedge your bets, especially from an international perspective on your portfolio risks. But the great thing about foreign exchange is you don't need to, if you do quote unquote cash out of equities, foreign exchange you can simply have it's a leveraged, you can view it as a leveraged product. So even if you need to have €1 million worth of exposure, you can get that exposure with, let's say, 200,000 euros, because you can leverage that 5 to 1, because currencies don't move generally. Now, we've seen some exceptions to that with this cycle, especially sterling, but they generally don't move by 20 to 30% increments, intra-month. So you can leverage your exposure just to free up cash flow or free up cash for other investments. So one needs to look at hedging that way in the foreign exchange space as something that can be done in a leveraged fashion. But I would say if you have no exposure to other currencies, why not keep them domestically given these prices? But some mix, yes, of euros and dollars, if not.
Finally, last question, almost same question. Do people in Denmark also the same? If they move out of equities, they also park their money in euros, in dollars, and Danish kroner?
Well, Danish krona has been essentially locked to the German mark since back in the mid-'80s, and since the age of the euro has been locked with a very tiny range to the euro. So it is not really a floating currency. It's unusual in that regard relative to the Swedish krona and the Norwegian krona, which are properly floating currencies and have weakened a great deal. So the Danish investors' perspective is really not, shouldn't really be any different from that for any country in the euro, the EMU, so the euro area that uses the euro as its currency.
Okay, thanks for the interview.
All right, thank you very much.